Good afternoon. My name is Mike Camara with Bogart Wealth. We'll give it a few seconds here and get started just to let some stragglers in. All right, well, we're about 2 minutes past. So thanks again for everybody that's joining. My name is Mike Camara with Bogart Wealth. This is a seminar around the after-tax rollovers and what's called the mega backdoor Roth strategy. I have a chat box going here. So as I'm going through, if anybody has any questions, feel free to type it into the chat. If I don't see it immediately, I'll catch it eventually. And by the end of the presentation, I'll make sure I go through all the questions that show up. So let's go ahead and get started. First, a little bit about us. Whoops, there we go. We are a registered investment advisory firm. We have about 2.2 billion of assets under advisement. We're completely independent, so we're not tied to any broker dealers, anything like that. We work as true fiduciaries. That primarily means we put our clients' interests first. We have an institutional custodian, which is Charles Schwab, meaning that we don't hold any money here at Bogart. All of our clients' assets, the 2.2 billion that it's under advisement, is held at Charles Schwab, third-party custodian. These are our advisors. There I am. I'm a certified financial planner. I've been doing this for almost 18 years at this point, but we have a lot of experienced advisors on our team here. This is some of the rest of our team in our planning operations group. We also have our investment team and our tax team. Our tax team is located here in Texas. Our investment team and our operations and planning team is in our Virginia office. And speaking of offices, these are our 3 locations. I'm in the Woodlands office. We have an office in downtown Houston, and then again, McLean, Virginia. So our mission is to help our clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. This just touches this process that we like to go through. We like to do a retirement analysis and then look at cash flow and withdrawal strategies for our clients, put together tax planning and tax optimization, investment management and a tailored investment portfolio. We then look at estate planning, trust reviews, and then once we've done all that heavy lifting, we want to continue to review and monitor a client's plan. Everything is centered around the plan. Now you'll notice this is a circle. We don't just put together a plan and say, okay, good luck, hope it works. We treat retirement planning as something that's never done. So not only leading up to retirement, but through retirement and for the rest of your life, we want to be running your plan numbers at least once a year. So as part of this seminar, we invite you to have a complimentary one-on-one financial strategy session with us. That's no commitment. It's just a way for us to get to know you, you to get to know our situation or our firm, us to get to know your situation on a one-on-one basis with no commitment to become a client. It's a way for us to get to know you, again, you to get to know us to see if we would be a good fit. So this is part of the series that we consider retirement readiness. And this is some of the other topics that we cover and the other seminars that we do. So we have our retirement planning timeline, retirement income planning, Social Security strategies, tax planning and tax law changes. This is one that's obviously a lot more up to date. Estate planning strategies, NUA, which is net unrealized appreciation, long-term care planning, Roth versus traditional IRA and 401ks, and then this seminar is the mega backdoor Roth conversion strategy. So all of these seminars are posted on our website as well. So we'll have the recordings there. Many of the seminars here are already there, so you can see some of the older ones that we've done in the past. So the agenda for today is the overview first of retirement plan account types. Then we're going to get into Roth conversion basics and reasons to convert. Then we're going to talk about how the mega backdoor Roth strategy works. We'll talk about in-plan Roth conversions and after-tax withdrawals, which are two very different things. We want to make sure there's a clear differentiation between that. And then we'll give an example of the mega backdoor Roth strategy. So let's start by talking about what is a qualified account. A qualified account is another way to think of a retirement account. So think about your traditional 401k IRA, 403B, or 457. Money is saved on a pre-tax basis. So most people think of qualified accounts as pre-tax accounts. You save taxes every year while you're saving for retirement. So basically, as you're putting money into your 401k or your IRA, you get a top line deduction from your gross income. You pay no taxes on the gains or any appreciation until it's withdrawn. You pay no taxes on dividends. And in a lot of cases, you receive a company match on the 401k. But there's another part. First of all, there's a tax penalty of 10% if money is taken out early, and that is prior to 59.5. Now, there are some exceptions to that, but for the sake of this seminar, we'll leave that, we'll table that for now. Every dollar, both original cost and appreciation, will be taxed as ordinary income whenever you take that money out. And basically, you have to promise to take the money out, every dollar out during retirement. Basically, what that is government required distributions. So the government enforces this by scheduling required distributions at the age of either 73 or 75 if you were born after 1960. That's a new law change that went into effect this year. 25% tax penalty will be assessed for any failure to withdraw after you reach the age of 73 or 75. So let's talk about the employer-sponsored retirement plans and how much you can actually put into those. Many times people think that they're maxing out their 401k when they're putting in the allowable pre-tax or Roth amount of $22,500. That's for this year. If you're over the age of 50 or over, I should say, you can do an additional $7,500. However, the total that can actually go into a 401k plan is actually $66,000. So the difference between the $22,500, $7,500 catch up and the $66,000 that you can actually put in there is going to be how much you can save on a after-tax basis. So $36,000, if there's no company match, is how much could be put in on a after-tax basis. Let's talk a little bit about IRAs. So the contribution limits for 2023 for IRAs are $6,500 plus another $1,000 if you are, again, at the age of 50 or older. That is going to be deductible typically, but if you have too high of an income, there will be a prorated amount that's deductible or potentially not deductible at all. If you are covered by a plan and single, basically if you make over $83,000, you will not be able to deduct that. If you file jointly and make over $136,000, you will not be able to deduct that. If one spouse is covered by a plan and you're filing jointly, then that limit goes up to $228,000. Anywhere in between $218,000 and $228,000, it is partially deductible. So let's talk about Roth accounts now. Everything we were talking about were pre-tax accounts. Roth accounts can be in the form of 401ks or IRAs. Salaries or contributions are made on an after-tax basis. The company match will still go in there and the company match would still be considered pre-tax. The benefit of a Roth account is that you get tax-free growth. No matter how much it grows, all of that growth will be tax-free. The tax-free, then whenever you take withdrawals, the principle is always that the tax-free withdrawals of growth assume that you are over the age of 59 and a half and the account has existed for at least 5 years. So said another way, in order for that growth to be tax-free, you have to wait until you're at the age of 59 and a half and the account would have had to have existed for at least 5 years. A tax penalty of 10% is assessed on any gains taken out early, which again is prior to the age of 59 and a half. Roth IRAs are also not subject to required minimum distribution. So over your lifetime, you can continue to let your Roth grow and you never have to pull any money out. However, Roth 401ks are subject to required distributions. So once you retire and you want to basically, if you have the benefit of not needing the money, roll it over to a Roth IRA so that you can avoid the required distributions. Beneficiaries also inherit this money tax-free. So the limits for the Roth IRA contributions are the same. $6,500 plus a $1,000 catch up if you're over the age of 50 or 50 or older. The income limits are listed here. So basically, if you're single and make over 153,000, you cannot directly contribute to a Roth IRA. If you are married filing jointly and you make over 228,000, then once again, you cannot contribute directly to a Roth IRA. However, there are no income limits to doing Roth conversions. So what is a Roth conversion? A Roth conversion is basically paying taxes on some of the pre-tax money that you have either in your 401k or your IRA and flipping that over to a Roth. Why would you do that? A couple reasons, primarily because when you do a Roth conversion, once it moves into the Roth, all the growth from there is going to be tax-free. So when you're considering whether a Roth conversion makes sense for you, some of the things to consider are if income taxes for you will be higher in the future. If you expect your income and spending to go up significantly faster than inflation between now and the end of your life. If income tax rates all go up in the future, for example, to balance the federal budget, or if you are in what's called RMD prison, meaning that once you reach the age of 73 or 75, the government is forcing you to take out more money than what you actually need to spend and thus getting taxed on it. Last reason is to consider if you anticipate leaving a very large legacy to family or individuals and you want to take that tax burden on yourself so that the people you're leaving the money for do not have to pay those taxes. So let's talk more again about 401k contributions. So the total amount that you can contribute on a pre-tax or Roth basis. Now, keep in mind, this is not pre-tax 22,500 and then another 22,500 on a Roth basis. In total, between pre-tax and Roth savings, if you're under the age of 50, you can do 22,500. If you're over the age of 50, 30,000, that's including the $7,500 match. But the total that can go into a 401k on a pre-tax, Roth, after-tax, and including company match is $66,000. So let's talk a little bit about in-plan Roth conversions. This is going to be an example utilizing the ExxonMobil savings plan. Prior to doing any type of after-tax rollovers or in-plan conversions, you want to consider net unrealized appreciation and the effect it can have on that. So a withdrawal is very different from a conversion. And here we're going to be talking about conversions within the savings plan. Conversions within the savings plan can have unexpected tax implications. Employees younger than 59 and a half can convert a portion or all of the balance in their after-tax and general accounts to the Roth conversion account. However, funds in the before-tax account cannot be converted. The general account is where the company match goes. Employees at 59 and a half or older can convert a portion or all of the balance in their non-Roth accounts to the Roth conversion account, so basically everything. Retirees and terminees can also convert a portion or all of their savings plan balance to the Roth conversion account. The in-plan Roth conversion will not count against the 2 withdrawals allowed per year from the after-tax account once you separate from Exxon, but it is considered a withdrawal, so it affects the ability to do NUA. I encourage you, if you want to learn more about NUA, take a look at one of our seminars that we have on that. That gets into some of the nuances around NUA. For the sake of this presentation, we'll set that aside. The problem with doing an in-plan Roth conversion is that basically there's a pro rata rule on some of the earnings that you have made on an after-tax basis as far as how much of that has to be converted along with the already tax paid after-tax balance. So for example, if the entire after-tax account is, let's say, 60% after-tax contributions, that's money that's already been taxed, and 40% untaxed appreciation. The untaxed appreciation is treated as pre-tax money. The way it works is that if you convert 100% of the after-tax account to Roth, 40% of that will be taxable income. If you convert 50% of the after-tax account to Roth, 40% of that 50% will be taxable income. If you convert just 10% of the after-tax account to Roth, 40% of that 10% will be taxable income. Bottom line, if you do an in-plan Roth conversion and you have earnings on that after-tax money, you're going to be paying some taxes in the year you do the conversion. So as opposed to doing an in-plan Roth conversion, you may want to consider withdrawing the money and rolling it over to a Roth IRA. This is what is truly the mega backdoor Roth strategy. It's a way to get money into a Roth account without actually paying any taxes in the year that you do it. So this is looking at an example of the ExxonMobil savings plan. You can see here that you have an after-tax column and the balance is $562,756.85. Now there's a big not this arrow pointing to that. Why is that? Because that's not truly your after-tax balance. What is truly your after-tax balance is listed here. It's called pre-87, post-86 contributions. This dollar amount here is what is truly after-tax money. Think of this as your principal. That's how much has been taxed and put into the 401k account. The balance here, the $562,000, is how much this, call it about $274,000 has grown to. So that growth is considered pre-tax money. So if you were to do what's called a tax-paid withdrawal, which is the mega backdoor Roth strategy, you would be able to pull out the full amount of your pre-87, post-86 contributions, which is $274,000, or at least the balance of that, I should say. $274,049.15 is how much you can pull from your 401k. However, the pro rata rule applies. Let me go back just a couple of slides here again. Just like in the sense of this in-plan Roth conversion, that if you have basically 60% of your money being after-tax contributions and 40% being appreciation, again, remember that the appreciation is pre-tax, it has not been taxed yet. Just like in an in-plan conversion, you have to basically convert some of those earnings and pay taxes on it. With a after-tax withdrawal, you have to take out some of the earnings. Now, the way that you can avoid taxes on that is by rolling over the pre-tax earnings into a traditional IRA that's listed here on the right, and then the true post-tax money over to a Roth IRA. So in this case, the differentiation is determined by basically dividing $274,000, which is your post-tax balance, by the total balance, which is $562,000. You get a percentage of about 48.6%. You take 48.6%, multiply it by the balance of your true post-tax money, again, the $274,000, and then that's going to give you how much will actually be able to go into the Roth. So basically 48.6% of the $274,000 can be rolled over to a Roth, and then about 51.4% of the earnings has to come out, but can go over to a traditional IRA. As you can see, if you have built up a lot of after-tax money in your 401k plan, that's a lot that you can drop into a Roth. This can all go into a Roth in 1 year. And if you think about how much you can save on a Roth basis into just a regular IRA, let's say you're maxing out your 401k and then you want to put more money into a Roth IRA, well, the total you can do on a Roth IRA is $7,500. Where if you have enough after-tax money built up, you can drop in a lot of money. There's no limit to how much you can roll over to a Roth IRA. All this stuff that we're talking about, of course, we would want to talk on a one-on-one basis before, recommending somebody execute this on their own. So let's give an example of a mega backdoor full year, basically. So let's say that the base salary is $200,000. They're at a 24% marginal tax bracket, saving 11% pre-tax, 9% after tax, catch up at $625 per month, and then company match at 7%. This assumes the employee is over the age of 50. Basically, the total that you would put in on a pre-tax basis would be $22,000. The total that would go in on an after-tax basis would be $18,000. The catch-up would be $7,500, and then the company match at 7% this is again using Exxon as an example, would be 14,000. So the total would be 61,500. The amount that you would be able to roll over to a Roth would be $18,000 versus the 7,500 direct Roth contribution limit. So basically, through saving in your 401k plan and then rolling it out into a Roth IRA, you can put a fair amount more money into said IRA. So basically, in a very simplistic way to look at it, you save on an after-tax basis of $18,000. The 401k is a pit stop. It's kind of a loophole, basically. So you put your money into the 401k, and then as soon as you can, you roll it over to a Roth IRA, and that money is then growing tax-free. As soon as it's in a Roth IRA, and no matter what that money grows to, the money is going to be growing tax-free. Again, as long as you wait 5 years from the initial contribution and get past the age of 59 and a half. So this is a hypothetical growth chart on doing mega backdoor Roth rollovers every single year with a 6% growth rate. So you can see that, and this is assuming doing that example of 18,000 every single year. So in year one, we do 18,000. By year end, we're still at 18,000. Then we get 6% year over year. Over 10 years, we've been able to roll out about $180,000. And with the 6% growth rate, our balance is now 237, 254. Once you're over the age of 59 and a half, let's say in year 10, we're over the age of 59 and a half, and we have satisfied the 5 years, which again, that does not reset, by the way. It's 5 years from when the first dollar goes into the Roth. It doesn't reset where, okay, well, the money I rolled in year 9, I have to wait 4 more years. Doesn't work that way. Basically, it's from year 1, the first dollar, and then that satisfies the 5-year rule. And then let's say at year 10, we're at the age of 59 and a half. Essentially from there, all of this growth where we've turned 180,000 to 237,000, this entire balance is now tax-free. So by getting money into a Roth, it then grows tax-free. And if we were to say kept this money in the Voya plan or the 401k plan, and let's say we got the same amount of growth, well, we would still have $180,000 that we contributed on an after-tax basis. We're not going to get taxed again on that. But all of the growth, this 237,000, would be taxable whenever that's withdrawn. So very simply put, tax-free growth is better than tax-deferred growth or taxable growth down the road. So again, this is a very, very good strategy to consider. There are certain things you have to look at if you're close to retirement and NUA potential. But once again, this is a strategy that can, over time, get a good amount of tax-free growth going for you. So that's the gist of the seminar. This is a shorter seminar because it's a very narrow topic. If you have a after-tax balance in your 401k, we would invite you to contact us for a one-on-one session. This is something that I do highly recommend for people that are further away from retirement to utilize this strategy. It's a way to get tax-free growth. It's a bit of a tax loophole, completely legal, of course, but I do see down the road that the government may close this loophole. So while you can, if you have a significant after-tax money in your 401k, consider talking with us and we can talk about strategies around getting that money out and growing tax-free. Whether you do it with us or whether you do it with another firm, again, strongly consider moving that money into a Roth IRA. So thank you for attending. This is our contact information. There's mine. My name again is Mike Camara. I'm a Vice President Financial Advisor. There's my phone number and email, and then we have the rest of our advisors here. Feel free to reach out to me directly or anybody on our team if you'd like a complimentary and confidential retirement planning session to look not only at this type of strategy, but your bigger picture financial plan. I'll pause here for a moment, and if there's any chat questions, please put them into the chat. Yep, Christian Andrews. I'll start you.
Sorry, can you hear me?
Yes.
Okay, apparently I was muted. And also your chat is locked to adding any questions.
Oh, sorry about that.
That's okay. So the question I have is, if you're wanting to use this strategy, but you're not working with enough funds to both max out the 401k and also put this max money in this after tax, which one is better to use?
So it all else being equal, if you're not maxing out the 401k, like doing the 22,500, depending on what your income is, you probably would want to first max out the 401k. If your income's low enough, you can also just save directly on a Roth basis, essentially.
It's
after
not.
tax. Oh, I'm sorry.
It's not. So
yeah, after tax is when you've completely maxed out the 401k, and then you have that additional spillover. So until that happens, I would continue to just save on just the regular 401k. And again, if your income is not so much that you're in a high tax bracket, you can just save directly in the Roth 401k, and then that's growing tax-free as well.
Okay. Thank you.
Absolutely. And then Andre, see you there. Hey, Andre, I just got you to talk there. I think you're on mute though.
Yeah, I actually joined late. So the question I would have is, can you share this deck after the fact or no?
Yeah, I'll send it to you.
All right, appreciate it.
All right, that it?
Yeah, well, once I review, I'll let you know. But I think most of I have very little in the after tax 401k, so I'm not sure if this is a suitable strategy for me or not, but I'll take a look and talk to you about it.
Okay, sounds good.
Mm-hmm.
All right, and then Mary, got you there.
So I'm only 2 years from retirement and I don't have a large balance in the after tax. What do I do for the next 2 years?
Do you have a lot of Exxon stock in your 401k?
Maybe I did. I know I did a rebalance at some point a couple of years ago. So I'm not sure how much it's at now.
That's probably something we want to look at kind of one-on-one for you. So if you want to set up some time, happy to look at that directly. I mean, I still think that getting that money out into a Roth might be advisable, but since you're close to retirement, there's some NUA potential. And again, for the sake of this presentation, we don't really get into that simply because NUA is a whole another topic in and of its own that we have a very much longer, more in-depth seminar around. But we can look at that individually. But I would say that it's something to consider. Even if you only got a couple years, the sooner we get into the Roth, the sooner we're getting it growing tax-free, and that could be 2 years of tax-free growth, especially if the market keeps going like it has been, basically. So I would say, let's look at that if you want to set up some time.
So since I don't have a large balance in the 86, 87 after tax, would you recommend that I switch my current contributions to all go to Roth?
No, or after tax, no, I wouldn't. I would still, if you're not maxing out the 401k.
No, I am.
Oh, you are? Okay. So once you max out the 401k, there's another thing you can do that we didn't really get into in this seminar. There is, if you have some extra cash on the side, you can do what's called a special contribution.
Okay.
Where you can actually write a check to Voya at the end of the year. And let's say, for example, you've done all your savings, you've got, the company match in there, and you could still squeeze in another $20,000 of after-tax money, but it didn't come from your payroll. You could actually write Voya a check for $20,000 and have them put that into the after-tax bucket, if you will, and then we can roll that money out into a Roth. So I wouldn't change the savings necessarily. Again, we'd have to just kind of look at that as far as what your income is and all that good stuff on whether pre-tax or Roth makes more sense for you. But if there is some additional cash you have on the side too, there are other ways that we can squeeze in some more money on an after-tax basis there as well. So like I said, I would want to look at that, one-on-one with you.
Okay. All right. Thanks.
Yeah. Feel free, to reach out, and you got our contact info there. You can shoot me an email and we can coordinate a time.
Thanks.
All right. So sorry, I didn't realize the chat wasn't working. I usually do get some questions. I didn't see that. Anybody else want to raise their hand, or, feel free, if you're not comfortable talking, you can shoot me an email directly And I'm happy to respond to any questions that people would like to have or go through as well. But I'll give it a couple more minutes just in case anybody else has any questions. But that's pretty much the presentation. I thank you all for joining here.